Video will try to understand the capital asset pricing model. Okay, so the capital asset pricing model we already saw in the previous class that the total return possibly signifies the expected and unexpected return. So the capital asset pricing model is mainly the tool used by investors, which theoretically represents the behavior of financial markets. Okay, so this helps the investors to quantify risk and return, and based on that they try to possibly calculate what is the estimated return of an individual security or a portfolio. Okay, so what we are trying to understand is the total risk. So last class we try to understand total return, right? So total return has two components. One is the expected return and the one is the unexpected return. The same way, the total risk you can classify into systematic and unsystematic risk. Okay, so systematic risk and unsystematic risk are one of the total risk what you can possibly classify. Okay, unsystematic risk. So the systematic risk are mainly what you can see here are the market risk. So which means systematic risk are those which are not firm specific risk, and these are the risk which possibly impact the whole industry or the whole economy. Okay, so the examples of systematic risk, it could be GDP, political stability, inflation, FDI, unemployment rate, and goes on, right? So what you see in this particular plot, the x-axis typically talking about the number of stocks, and the y-axis is talking about the total risk. So the total risk can be classified into two. One is the unsystematic risk, and other one is the systematic risk. So the unsystematic risk are specifically the firm specific risk. Okay, so if you see this plot, if you see here, it is drastically reduced, and this can be reduced because when you diversified your portfolio, this risk will be completely minimized. It will not be zero, but it will be minimized to a greater extent. But of course, if you continue to do that, this particular arch will go up. So again, this has an optimum point. So you need to pick the assets which are negatively correlated, and this firm specific risk can be minimized. But the market risk, if you see, which cannot be minimized because this is uncontrollable in nature. Okay, so so what we are trying to understand is using the capital asset pricing model, we can determine what is the expected return of an individual stock or individual portfolio. So this can be calculated using this particular formula. So the RF is mainly the risk-free rate of return, and beta signifies the market risk. Okay, and RM minus RM is mainly the excess return. So when you use this formula, it typically sets the benchmark based on which you try to compare what is the actual return of a portfolio with respect to the expected return, and then try to understand whether the particular stock is undervalued or overvalued. Based on that, you take a call whether the stock needs to be bought or not. Okay, and then it's important to understand how do we interpret the beta, right? Beta is the measure to measure the market risk, and the beta more than 1 typically tells that the stock is volatile. Okay, so which means the stock is very aggressive. So if the market is going up by 1%, let's say if the beta is 1.5%, then if the market is going up by 1%, then possibly that go by 1.5%, and it's the same if it goes down. So typically the beta tells about how the stock or a portfolio is going to respond compared to the index. Okay, the same way beta less than 1 indicates the stock is defensive and less volatile. Now how do you calculate the beta is? It's simply covariance of individual security on market risk, market return, and then standard deviation of market return. Okay, so what is the general assumption? It's important to understand in order to hold good the capital model. There are certain important disclaimers possibly you need to understand before considering this as one of the tools. So what one of the assumption it tries to emphasize is the capital asset pricing model only looks at from the perspective of market risk, and it's important that investors need to look at firm specific risk in order to make a decision of buy or sell. So the CAPM looks at only the market risk or index, and then try to compare it with the individual stock. So it doesn't look into firm specific factors. Okay. The second assumption is it does not consider any qualitative factors. So the qualitative factors are those which cannot be measured. Like it could be something like board composition, or let's say it could be any changes. Let's say the firm X is being acquired by firm Y, and this is just the news and still the deal is not finalized, and possibly this will not reflect the CAPM model when you draw it, because the CAPM model, remember, is derived based on the historical data, and there are many informations which possibly available in the market, and which as an investor you should be able to predict that how it is going to impact the company in the long run. Okay, so all those qualitative factors are not considered in the CAPM model. And please understand, when we did an activity of risk profile assessment, we try to understand that each individual investors are different in terms of taking the risk, and depending on their risk, they tend to see what is the maximum utility they are looking. But typically the CAPM model, when you draw it, the x-axis and the y-axis. So x-axis typically tells you the beta or the market risk, and then y-axis typically shows the return. And when you draw the capital market line, so you tend to identify what is the optimum point. So the optimum point is mainly the excess return and how the market is going to respond, and then the stock will be either above or below the security market line, which shows how the stock is responding as per the set expectation, right? So based on the risk averse, and so we need to understand that individual investors are different, and their expectation is also different. So it cannot be taken as a standard. So there is no standard, possibly a number which we can derive. But of course, we can say that what's the minimum return. So minimum return, of course, is something like above the RF. But of course, the maximum return is completely dependent on the individual investors, right? And then what we try to understand is capital asset pricing model holds good only when there are no insiders. So when there is no insiders information, or let's say there are no individuals who have the information well in advance, and they use that and try to manipulate the price. So we assume that there are no such instances and all the publicly available information instantly reflects on the stock prices. All right, only then that will be holding good. And of course, the capital asset pricing model does not consider any expenses out of the transaction. It could be the tax loss, or it could be the commissions and all that. And finally, investors hold diversified portfolio that eliminate unsystematic risk among stock holdings. So again, as I said specifically, the capital model looks only the systematic risk perspective because it measures the beta, which is one of the proxy for market risk. But the unsystematic risk, which is a firm-specific risk, needs to be very well diversified. In order to minimize that, it's important that it's very well diversified. Okay, and then finally, this is the same thing what I just explained just previously. So this is the capital market line, or we can call this as a security market line. If you have only one stock, then we call it as security market line, and then we have multiple asset classes, then we say capital market line. So what we try to do is we try to compare where the possibly the expected return is plotted when compared to actual return. So the M is mainly the market return, RF is risk-free rate of return. So if it is above the security market line, it is undervalued. So which means that you can buy the particular stock. But again, remember the disclaimer that it's important that you look into firm-specific risk, because in the previous a few minutes back we try to understand the total risk equals to market risk and the firm-specific risk, and we are trying to see only the market risk here and not the firm-specific risk. So before you make any call in order to buy a security or a stock, it's important that you look both the aspects. Then only your decision will be more effective. Okay, and then of course we already saw that how do we calculate expected return. So the expected return is nothing but RF plus beta into RM minus RF. Okay, all right, so in the next video let's work on the slide, and then we'll try to work on the live data. See you in the next video. Bye bye.